Eric, it was great to have Jeff back on the show. Listeners, you'll find the download link for the post-game trade of the week in your Research Roundup email. If you don't have a Research Roundup email, that means you have not yet registered at MacroVoices.com. Just go to our homepage, MacroVoices.com, and click on the red button over Jeff's picture saying looking for the downloads.
Patrick, for this week's Trade of the Week, let's focus on Jeff Curry's theme of de-dollarization and impact on metals. How are you thinking about positioning here, and what's the most compelling way to express that view?
Eric, coming out of Jeff's interview, my key takeaway is that gold isn't trading like a simple inflation hedge anymore. It's increasingly behaving like a geopolitical reserve asset. In sanctions-heavy world where supply chains and critical inputs are getting weaponized, reserve diversification into bullion becomes structural, not cyclical. So for this week's Trade of the Week, I want to look back at bullion. The gold correction has arguably come and gone, and after a meaningful 20% peak to trough reset, this becomes less about timing a perfect entry and more about maintaining a core long exposure with a volatility dampener in case we get one more retest of those lows. This is where the options market helps. Gold continues to carry a fat right tail skew, which means you can sell relatively expensive upside to subsidize downside protection and create a more asymmetric overlay. So for this week's Trade of the Week, I'm looking at the 90 by 120 collar overlay on the GLD. The gold ETF is trading at $476 at the time of recording. Using the May 15th, 2026 expiration, we are buying the 430 strike put for $8 and selling the 575 strike call for $5. That's a net $3 debit or about $300 per caller per 100 shares. What you're buying is a defined risk envelope. 10% below the price at 430, you've effectively put a floor under your position. On the upside, you stay long up to 575, which is roughly 20% upside. From here, you're paying a small debit to dampen downside volatility while still keeping meaningful upside over the next 90 days if gold resumes its primary trend. This is particularly useful for those investors that feel maintaining a strong overweight is necessary, which always comes with some concentration risks. Bottom line, stay core long gold. Add a low-cost collar to dampen volatility in case we get another shakeout, and use the skew to your advantage to keep the hedge asymmetric and inexpensive.
Patrick, every Monday at Big Picture Trading, your webinar explains how retail investors can put on our most recent Trade of the Week. For those listeners that want to explore how to put on these trades in greater detail, don't miss out on a 14-day free trial at bigpicturetrading.com. Now let's dive into the post-game chart deck.
All right, Eric, let's talk markets. What are your views here on these equities?
Patrick, the market was feeling pretty heavy, flirting with the 100-day moving average support for several days this past week. For now, we've bounced off of it. That's a little bit reassuring, I guess. But the market is still trading sideways at best, and a resumption of the uptrend remains uncertain. I don't have any strong timing views about what happens next, just concerned that if we do retest the 100-day and it doesn't hold, there's no obvious support until the 200-day moving average down at around 6,600 on the S&P. So hopefully we can stay above the 100-day, but if not, look out below.
Well, Eric, the story has actually been the same on the S&P 500 for the last couple of weeks. First of all, for months, we've been in a tight trade range and there has been no resolution. And that's because the market is actually torn under the surface. It has a huge and substantial correction occurring in the financial sector and in the software stocks, while we continue to see what I have on page 4, the semiconductor ETF chart breaking to fresh new highs, with NVIDIA just beating on its earnings. As well, on page 5, I have the KOSPI, the South Korean index, which is going full on parabolic. And so we have these stories of the AI story working on the semiconductor side, but yet on the software side getting hammered. The Mag 7s remain weak, and this is structurally heavy weight. Now, NVIDIA did beat on its earnings, but there isn't any extraordinary upside. In fact, it's relatively flat at the open. And And so we have a scenario, well, what is going to drive an S&P 500 breakout? And really at this stage, it would really take many of these very overbought Mag 7s to feel the need to mean revert and actually potentially rally for a short period of time. And that is really, in my mind, the puzzle to solve. If we find ourselves in 2, 3 trading sessions with NVIDIA giving back all of its gains, that will be a structural blow to the semiconductor story. And that could be what turns the tide, but it's too early to speculate. At this stage, we're in this trade range. The market is very heavy, but we're going to really need to see something give out for the sell cycle to kick in. It is noteworthy that near 6,800 on the S&P, only 150 points lower, are a lot of systematic trading tripwires that could really have flows pivot to the sell side. So it really is important for the bulls, if they want to maintain this primary trend, to keep this market above this 50-day moving average and progressing higher. All right, Eric, what are your thoughts here on the dollar?
The upswing stalled at about 98 on the Dixie, at least temporarily, but there's also no indication yet of any reversal to a lower swing trade. So the jury's still out, but absent a war, I think the rally is probably running out of steam here. The thing is, absent a war is not exactly to say it ain't going to happen, because let's face it, the very real possibility exists of a U.S. attack on Iran, and I think that would be dollar bullish, at least in the short term.
Well, Eric, it's interesting that the strength that we've seen in that US dollar over the last month has done nothing but a 50% retrace back to the 50-day moving average. And so the primary downtrend is still intact. If for whatever reason we're given a catalyst for the dollar to have a breakdown, we could easily find ourselves heading for either a double bottom retest or even a hit in the 94-95 handle on the downside. But with us actually trading right at this 98 handle, there is the window that if for whatever reason there's a risk off impulse and the dollar is bid, you could have a burst above that 50-day, which could pivot flows simply on a technical basis. Really, we're at a really important fulcrum point of where we're going to determine what's next. This 98 level is incredibly critical in my mind, and it's going to really be where we're going to find out whether the prevailing downtrend remains the path of least resistance. All right, Eric, let's touch on oil here.
Well, the rally in crude oil appears to have stalled because the fears of a strike on Iran haven't happened yet. Until a deal is reached, though, or an Iran strike is completely off the table, I expect the geopolitical premium to stay in the market, and I think that's what got us up here to this price level in the mid to high 60s in the first place. In the short term, and only in the short term, there's no supply crisis unless that Iran conflict creates one. So there's plenty of room for prices to come back down to the low 60s or high 50s if the Iran strike comes off the table completely. Longer term, though, the fundamentals are bullish, especially after the election window.
Yeah, Eric, when talking about oil, it's actually challenging to do a technical flows analysis when you've got such a huge geopolitical headline risk that could really change the trend very, very quickly. Overall, over the last 2 months, oil has been very well accumulated. All supports and sell-offs have been held. Everything is in good trend. But really, I think the next big move on crude oil will be headline driven. At this stage, everything technically remains bullish, and if the news in any way spooks oil traders, we could have a quick surge higher, very reminiscent of what happened last June when the nuclear bunkers were hit in Iran last time. At this stage, we're still very nice and clean in that bull trend, and we want to respect that trend, even though the risks are high here from that headline risk. All right, Eric, we got to talk about gold here. What are your thoughts?
Patrick, in my opinion, this week's move above 5166, which is the 61.8 Fibonacci retracement level of the correction that just occurred back on January 30th, that move that occurred this week already is unexpected and very significant. What we need to see here, and I should say as I'm recording, we're above 5,200. If we can stay up here above 5,166 and even better yet, above 5,200 and close there on Friday so that we end up with a weekly close above that 61.8% fib level, that's a pretty good technical sign that we might already be moving toward an upside resolution to this correction. And frankly, that's faster than I expected it. I thought it was going to be several months before this correction played out, considering how brutal it was and how it shook so many weak hands out of the market.
Well, Eric, we did talk about this during our trade of the week. And overall, I view the long term trend of gold to be very, very bullish. And it's very likely at this point that that low near 4,500 that was established during the market correction is very likely to be the lowest gold is going to trade. But it is very common for after such a blow off on the upside for there to be multiple months of consolidation before the bull continuation pattern. So the one thing we just want to make sure to highlight here is that while the primary trend is up, while the macro conditions are very bullish, one simply needs to make sure your duration matches the realistic time frame it's going to take for gold to make a new breakout. I think that if gold is destined to make fresh new highs, it very much is a second quarter story, and anticipating some consolidations and maybe even a retest of a 50-day moving average as a possible outcome here on gold over the next few weeks. Overall, all dips should be bought and used as a tactical opportunity. All right, Eric, what are your thoughts here on uranium?
The uranium stocks moved nicely higher this week, but not with the gusto that I was kind of hoping for. The daily slow stochastics are high again, but they're not overbought yet. So hopefully we can see this move continue and continue a bit farther, but I wouldn't be surprised if we do get another swing trade lower into next week.
Well, the entire pullback on the U308 has been just a traditional retracement. So the primary trend of higher highs, higher lows, above all moving averages remain intact. And so I'm going to give the bulls a benefit of doubt that there will be a resumption on the upside trend here.
Patrick, before we wrap up this week's podcast, let's hit that 10-year Treasury note chart.
Finally, touching on that 10-year yield, we continue to see pressure on interest rates lower as bonds are doing well here. We're coming right to that 4% critical level. This is a level that was tested numerous times last year, back in April and October, and each time we broke below 4%, even on a temporary basis. It spurred a very rapid recovery. We're going to get a very important tell here as we come and test those critical levels again. Will we see the same type of gusto and velocity on yields to rise, or will we see that they stay down here on a sustained basis and that we're entering some sort of a different interest rate regime period? The tell is going to definitely be on how we react off of a test of this 4% level.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com. Patrick, tell them what they can expect to find in this week's Research Roundup.
Well, in this week's Research Roundup, you're going to find the transcript for today's interview, as well as the Trade of the Week chart book we just discussed here in the postgame, including a number of links to articles that we found interesting. You're going to find this link and so much more in this week's Research Roundup. That does it for this week's episode. We appreciate all the feedback and support we get from our listeners, and we're always looking for suggestions on how we can make this program even better. Now, for those of our listeners that write or blog about the markets and would like to share that content with our listeners, send us an email at researchroundup@macrovoices.com, and we will consider it for our weekly distributions. If you have not already, follow our main account on X at MacroVoices for all the most recent updates and releases. You can also follow Eric on X at Eric S. Townsend. That's Eric spelt with a K. You can also follow me at Patrick Ceresna. On behalf of Eric Townsend and myself, thank you for listening, and we'll see you all next week.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at MacroVoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.